it hurts you for 12 months. Stays on for 24, hurts you for 12, because then over time, that negative impact goes away. So that's one thing to keep in mind. It's so important, like we talked about making sure you pay your bills on time. That's very important. On the due date, because if it's after the due date, that's when you have late fees and things like that, right? But that doesn't mean you've gone 30 days late. Because remember the reporting cycle we talked about? The statement closing date or the billing cycle date? The way that works, if you think about it, hey, didn't make my payment on time. I waited until I got my next bill. I'm now past due $100. I now owe $200. Well, that statement reported that information. This person is now past due, and they've gone 30 days late. That's when the first 30-day late reports. So if you ever get in a situation where you're tight on money or something like that, and you're trying to figure out what do I have to do, sometimes you're going to have to pay a fee, obviously if you're late, but the one thing you definitely want to avoid is a 30-day late, period. You want to avoid that. Now, kind of did this somewhat, right? 30%. What would you guess the next most important aspect of your credit score is? We talked about it with the credit cards.
Credit usage.
Yep. Amounts owed. Revolving debt ratio, I like to call it. So revolving debts. What are revolving debts again?
Tires.
Not a card. Credit cards.
Oh, instant.
Yep.
Retail
You
line
charge
of
them
credit.
out, you can pay them down.
That's
you can
revolving.
Use them again.
Anytime, so installment's different. Installment is based on loan balance, interest rate, and term. I'm paying that down over time in a certain term. Revolving is going up and down. You can use it, pay it, use it, pay it, it's revolving. That's the biggest difference. 30% of the FICO credit score is based on how you manage those accounts. That's huge. There's other factors, but that's the major factor of this 30%.
Remember how I said that was so important?
That 1 to 3% ratio, utilization ratio of the credit card, that's why it impacts you so much positively if you do
Yep.
that. That's
You-
huge.
You have direct control
Yep,
over 30% of your FICO score. That's pretty powerful.
it's huge.
And if you don't have a credit card, guess what you're not even getting?
You're not even getting this. If you don't have a credit card, you're missing it. Yep.
So when you make a purchase and they ask whether it's a debit or a credit, what would you recommend you do most of that?
If you're using your debit card, even if you press credit, it's still technically debit through your checking. It's just the way the system works in the back end is, that's why you have a Visa logo on it, MasterCard logo. They're utilizing those companies for that transaction, almost like a middleman. So that's still a debit through your checking. But if you're using an actual credit card, that's credit. That actually reports. So
A
that's the
credit card
difference.
is borrowed money.
Exactly. Yep. So that's once again, income and what's in your bank account doesn't impact the credit score. Same thing with that debit card. So this is huge, guys. Revolving debt ratio. I really want to hone in. Now, on the budgeting side, now most of you guys have credit cards, I saw, right? How, and you don't have to tell me specifics, but are any of you guys at 1 to 3% ratio right now? You are?
Higher.
Higher? Everyone's higher? Most people are, that's fine. Now here's what I'm talking about on the budget side. Strategic debt reduction, I call it. Because 30% is based on the revolving debt ratio, those cards, one thing I want you guys to do when you go home, when you're working on your budget, and you're looking at the current balance limit ratio, the payment due dates, how much I owe, everything, take a look at how long you've actually had that card. Because there's something that's right here, length of credit history. 15% of the FICO credit score is based on length of credit history. That's huge. That's time. How long have I had credit? How much? What is the history? So that's something that you can't necessarily manipulate because it's just time. But once again, on a strategic debt reduction side, if you focus in on first, hey, okay, I got my budget put in place. I have 3 credit cards. Minimum payments are $20, $20, $20 per month. Let's say $20. But I have one that was open in 2006. I have one in 2009. And I have one in 2012. Which one would you want to pay down first? What do you think? The oldest one. Exactly. Because 15% is length of credit history. 30% is based on the ratio. If we start bringing down the card that's been established the longest first and bring those ratios down, it will positively impact your FICO credit scores quicker. You know what I mean? So if you're honing in on 2 things, this is what's so great about it. hey, I want to get on track with my financial situation, I want to pay down my debt, I want to save for a down payment of a house, I want to save for my future, I'm rocking and rolling, I'm feeling good. Okay, I need to pay these down. Well, then you also have, let's say you have any lending goals, down payment of the house. Well, once again, to be approved of that house, you're going to take credit, right? Well, let's hone in now and pay down debts, using strategy to improve FICO credit scores faster. That's what it's all about. So that way it's almost like a snowball effect is what you want to do. So on a budget side too, on debt reduction, I do support the snowball effect, and what that is you lay out, okay, I have minimum payment 20 here, 20 here, 20 here. I'm going to work on making obviously on-time payments, but I'm going to put additional cash flow towards this card first, not spread out between all three, focus one at a time. I'm going to bring the ratios down to that 1 to 3%. I then snowball down to the next one, snowball down to the next one. Now, if you check out Money Mastery, one thing through Money Mastery course that I teach and I'm certified in is on top of that, if you already have a budget put in place and your cash flow can support that type of output per month, instead of paying down that debt and then saying, okay, well now I can just use this cash wherever I want, I can buy this, I can buy that, you don't want to do that. You want to use that same budget, how much you're paying down, to then pay those other ones down even faster, so you put more per month. Then when you get it down, you can use that same amount of money to then save for the future. That is key, because once you get used to making those monthly payments per month, you're used to it. You know what I mean? That's what it's all about, behavior. If you understand I paid this off, you want to use those funds in the right way. You don't want to then use it and go buy things. You want to use it for the future, right? And all that's going to do is make life easier in the future too. You can get the things that you want. 10% types of accounts, that's what you talked about. Revolving and installment. There's actually different types of revolving that we talked about. Secured credit card, unsecured credit card, retail lines of credit, store credit cards. So one thing that we do promote is having a healthy mix within the revolving accounts too. It doesn't necessarily mean you have to have a secured card if you don't have to have that. Let's say your credit, you can get an unsecured, but maybe you get 2 unsecured credit cards and a retail line of credit. Now you have 3 active revolving accounts and there's a mix between the 3. That actually will help boost your score slightly too when managed correctly. And then 10% is recent history, so it's inquiries. It's about new accounts. I'm credit seeking, I'm inquiring towards this credit card, I have a slight negative impact to my score because of that. The new account reports, there's a slight negative impact, right? That's what that is, recent history, inquiries. And one thing to keep in mind too, when you apply for something, because a lot of people don't know how this works, when you apply for something and there's that inquiry, your credit score is going to show you what your score is already with that deduction of the inquiry. So it's not necessarily hits you and then it's even lower than what you think. That is showing already the deduction of that inquiry and the score points cost, just so you guys know. So just a little bit technical stuff, but I'm a technical person. But it's good to know these things, So this is important to know, because if you go to myfico.com, you go to freecreditreport.com, Credit Karma, all sorts of stuff, you'll see this chart, but when you just see payment history, amounts owed, blah, blah, you don't know what that means. I mean, you have an idea. It's all about the why, and then using that information to your advantage, so that way you can start working on your credit. That is so important. I know today our focus primarily was on credit, and the only reason why that is a lot of people are very confused on credit. They don't understand how to build it, how to manage it, because that, like I talked about before, is going to lead to better financial success. It will. And then once again on your guys' budgeting, you want to take those things into consideration. Going through your budget, pull your bank statements, start saving your receipts. You don't have to do it forever. Once you get a budget down and you start getting into that habit, you don't have to do that forever. You still want your budget, but you don't necessarily have to save every single thing, because you'll have a plan. You know what I mean? And I highly recommend looking into the Money Mastery app. It doesn't impact me in any way financially. It's just a great app. There's other ones out there. Wells Fargo, actually, through their banking system, has a great back-end budgeting tool where you can actually track where your money's going, and they put it in categories with the graph and stuff. That's a part of your account. So there's a lot of stuff out there. You just have to search. That's why we have Google.
What do you recommend for Credit Karma or acquiring your credit?
That's a great question.
There's so many other frequently reported cards.
There's a lot. Here's one thing you got to keep in mind about all consumer credit monitoring sites, even myfico.com. The credit score that you get on there is not a true FICO score. This is used when it's a credit seeking inquiry. This algorithm is specific to that. When you pull for consumer purposes, it's a consumer credit score. So Credit Karma actually uses the Advantage 2 scoring system, which is a consumer credit scoring algorithm, and there's a big difference. That goes up to 990 as a cap. Even though on their graph they might show 850, that's not accurate. It's a consumer credit score. It's a completely separate model. It's not uncommon to actually look at your Credit Karma score and see 666 and go, okay, I'm not that bad. I want to get a mortgage. I hear 640. You go apply for that mortgage and you're at 620 or 590.
580, yeah.
It can vary that much. Now, I'm not opposed to Credit Karma. They do a great job. They do a great job of a detailed summary of what's on your report. That's very important. What's actually on my report? What's impacting me, positive or negative? Because that information, data is data. The score is separate. One downfall on top of that, though, Credit Karma is it's just 2 bureaus, not 3. They don't have Experian on there, but it is a free service, so that's really nice. If there's one that's a cost-based service that I prefer is Identity IQ. They're great. We actually have a link if you guys want to reach out to us. They normally charge $29.99 a month, but we have a specific link that it's $19.99 a month. $1 for 30 days and $19.99 a month.
Yeah, they do a 30-day trial for $1, so if you even
To see
just
if you
want
like
to get
it.
one report.
But what's nice
one
about the
complete
Identity IQ
buy
report,
multiple.
all 3 major credit bureaus, all the data, a full report, all the data. It shows a lender rank, so where you stand with actual lenders, poor, fair, good, excellent, all that, and it shows your credit score. Even though it's a consumer credit score, it's going to be a little bit closer to FICO.
Yeah, it's a lot closer than some of the models out there.
Yep. So that's
why we like to use it.
yeah, and it doesn't hurt your score. Remember, because it's for consumer credit monitoring, so there's no negative impact to your score.
Student loan debt.
Yep.
Does that, I've been told, it doesn't impact your credit score based on
Oh.
your, well, that's like negatively or, well, maybe positively.
It's
But when you're sort of negotiating and working on your payment terms.
that's I've heard that a lot, and I don't know
Yeah,
where that came
that's
from.
not- yeah, that's not.
Because that's not true.
That's not
Yeah.
true.
It's an installment account. It's a loan.
Right.
So the one thing that's nice about student loans, credit-wise, is this: when you're in school and you're getting disbursements,
Is it private and federal?
nope,
No,
both
both.
sit- considered the same. Now the type of loan's different, but the way it reports is the same.
Right.
They're installment accounts. So when you're obtaining disbursements, they report. Here's actually important to know: they report as a separate loan. So even though you might have Navient, Fed Loan Servicing, Great Lakes, private, Sallie Mae, I mean whatever, or there's all sorts, Wells Fargo,
Yep.
it's going to report separately. So even though you have one servicer, you might have 8 different loans.
Right. One loan for every term you go, because they never know if you're going next semester.
Exactly. Now, if you're in school deferment, right? So you're not making payments, but it actually still reports timely payments that entire time. It's in positive standing. So in a way, that actually is a positive. It is. Now, here's a negative though. Let's say you go 30 days late. You have, Great Lakes, and I have 9 separate disbursements, but most people, they're not getting it. They assume that's just one account. You go 30 days late, you could have 30-day marks on 9 separate loans.
You just got 9
That would
various.
just absolutely destroy the credit scores.
Yeah.
So that's one thing to keep in mind.
So stay ahead of them.
Yep.
Establishing and cleaning up credit,
Okay.
Yep.
both, together or separate. What's like a good time frame? A year,
It's
5 months, 6 months?
Depends. I hate to give that answer.
So everybody hears what he asked.
So what he's asking is, when it comes to like credit repair and credit building, what's a realistic timeline to get back on track? I like to tell clients now, and in any way I'm not promoting our service, there's other companies out there, but if you approach both proactively, the proactive credit building and management and repair, 6 months is very realistic in my
That's
opinion.
Pretty reasonable. Yeah.
Yep, unless they've gone through a bankruptcy recently, they have a ton of accounts, maybe a foreclosure or something, that's obviously a lot more. They might take a year to rebound from that with all those steps. But if it's more of, hey, I had some issues, I made some mistakes, I have some collections, some late payments, some closed accounts, charged off accounts,
Right.
whatever, realistically, 6 months. If you give yourself like a 6 to 9 timeline, that's perfect.
Okay, you'll be in great shape.
What's the cost of using a service like you guys? Not that you need to like,
Yeah.
in general.
Yep, on average, a monthly payment for the service ranges between $89 to $135 a month. And that just depends on the service. And a lot of
What
companies are
is
very
included?
similar to that. The way that we operate, like other companies, is a month to month. So you're not locked into like these long contracts if
Right.
you're stuck in it. A lot of companies in the past would do like year long and really kind of stick it to you. And even if you got to your goal in 6 months, you know, so that's one thing. There's actually a nonprofit organization out there, Lutheran. They don't do credit repair, but they do help with budgeting and things like that, so you can kind of do the proactive sense, yep. So it just depends on what you're trying to accomplish, you know. One thing that we do and a lot of companies do is they offer free consultations. So to be able to actually go through it in detail, hey, here's what's on my report, here's what I'm looking to accomplish, how do I put this all together, you know?
So then what do you guys do?
A big part of at least what we do is we help with credit repair. So strategically challenging those negative accounts. It's all about in a way that it's not so much like, let's say you had an old collection. It's not necessarily challenging the validity of that as if it didn't happen. It's more of understanding, is it reporting accurately or did it, and can they verify that today? Now, at any point they can't, the bureaus must permanently delete it off your report. Same thing with late payment history, things like that. So you're repairing your past, and then what we hone in on, a lot of what we've talked about today, because I firmly believe, I mean with all my heart, if you don't do those proactive steps, you can easily still fail.
Yeah, you won't.
Repairing your past didn't really do you anything. You just, yeah, you repaired it, but you haven't done anything for your future. So a big part of what we do is we do coaching with our clients and really help develop a budget, help, you know, proactive credit building, credit management, hold you accountable, almost like a personal trainer would. Hey, did you exercise? Hey, we'll get in here right now, let's exercise. Did you eat right? What? You didn't eat right? Now you need to eat this. You know, it's the same thing. You know, so that's a big part of what we do to really help people. It's more about behavior changes and making sure that we don't necessarily want repeat business. We're not here to Band-Aid, you know, put a Band-Aid on it and say, okay, now move on and come back to me later when you mess up. We want you to fix it, do it right, so you don't come back.
Big on education, if you can't tell.
Yeah, it's very important to us. Because it's something that's not taught. That's why I'm so thankful to have this opportunity to do this, because this is not taught.
No.
And it should be, because people would be in a better position today if
Senior
it
year
was.
high school. Absolutely.
Yep.
Any other questions, you guys, or things?
Are there any, can you recommend a book to read about credit rebuilding or credit repair, or should I just Google something because there's so much out there?
There's a ton out there.
But it's the wrong stuff too.
I know,
Yeah.
the books that are out there, some of them are horrible.
One thing that you could do, if you want, write down yourcreditlife.com, and then if you do Facebook Credit Havens, my last name is Havins, spelled a little bit different. We have a ton of free education.
Yeah, free education, free
Completely
free
free.
podcasts.
That's good.
YouTube
That's
channel,
good enough.
podcast,
Yep.
material, everything, all free.
So, and you're gonna teach, because you know what
Never
kind
mind.
of caught me up, Dan, I'm trying to be quick. The statement date, the closing date, and the due date, I have to, you know, kind of really
Visualize
work those.
that, yeah.
Yes,
Yeah.
so that I can, because basically you're saying live within your means, even though you have a credit card, you
Right.
still have to budget. If you
Yep.
can't pay for it at the end of the month, don't charge it, basically,
Bingo.
unless it's
Yep.
like an emergency, so.
Right.
Cause I'm thinking, oh, credit cards, you know, you can just do this, do that,
Right.
and then just pay it all out, you know what I'm
Yep.
saying?
Mhm.
But you're like, no.
No, use them a
1 to
certain
3%.
way. It's a strategy.
So I'm
Yep.
like, shoot, that's like living within my
If you
means
get
anyway
yourself a
still.
credit card, you know, one thing, you've got my card, honestly, if you get yourself a credit card, you wanna take a picture of your statement, like, even text it over to me.
Okay.
I'll like circle what the date is and shoot it back, and that's it.
And
I'll make
that's
sure you
good,
know
right.
where, yeah, I've got no problem doing
Yeah.
stuff like that for people, you know.
Yep.
You don't have to
Cause
hire a guy
I
to do
really
that.
wanna build my credit, so I
That's
can
good.
get a house.
There you go.
And,
That's the biggest
you
goal
know,
most people
and
that we
it's
talk
like,
to have.
I had no clue about a lot of this stuff.
Yep.
It's like, or I'm relearning it, I've heard so many
Yep.
wrong.
And it's because this industry right now is a growing industry, at least credit awareness.
Mhm.
So you have the credit bureaus, you have Credit Karma, and they're doing commercials and all sorts of stuff. And the issue is it's a growing industry, and a lot of people still have a lot of misinformation from the past, and they're still promoting that today. That's the issue. You know, so it's really honing in on understanding the realities of how it actually works now, and then being able to use that information to your benefit so you can better your situation.
Other question? Go ahead.
My question is, if you have to make a choice to pay your credit cards or your debt, does it make a difference to start with the one that is with a higher interest rate? to
No.
pay that one first because it costs you more money?
And I just wanna make sure I understand your question. Is it more of, like, is it more of saying, hey, if I didn't have enough to pay everything, what should you pay first?
I
Or
mean,
is
pay
it,
everything minimum payment, but if anything extra, pay towards the one that has got higher interest rate.
now that's definitely another option.
Yes,
Oh.
It is.
That's called cascading.
Yes.
Where
So-
you take the cost of money.
Exactly.
Eliminate the cost of money.
You have to understand what you're looking to accomplish. So if your main goal is to pay down debt but improve credit scores the quickest, you'd want to make the minimum payments on all those accounts, but then pay the one down revolving accounts that have been open the longest first.
The oldest.
Now, if you don't necessarily have a goal like that, and you want, then it definitely makes sense to then pay down the higher interest rate accounts first, because now you're saving a lot more in interest over time. And another quick thing I want to touch on, for anyone that, for the unforeseen, that something bad happens, right? Loss of job, medical, something, right? And you're forced with the decision to know, what am I going to pay and what am I not? There's a portion of the score of FICO, it's called rank order risk. And what it means is the higher the balance, the more important it is. The higher the rank is. So if you have a mortgage, that's rank 1. If you have an auto loan, it's rank 2. Maybe higher student loan debt, that could be rank 1, 2, 3, it doesn't matter. What's the highest balance? You want to make sure you stay on time with that. And then work it down. That's a big piece. That's more of it, if the unforeseen bad happens and you're trying to mitigate the damage as much as possible, that's what you want to do. We should just do like a 3-hour class.
Are there topics that maybe weren't addressed today that you would like to share with them for future sessions? Is there anything that you like, well, we didn't even talk about this or that? Could you just, anybody feel comfortable sharing anything? Yes, other questions?
Would you,
Or do we fry your minds?
because we're gonna do this again in November, and I know it's a lot, it can come back obviously, 'cause it's a lot. I mean, if there are any suggestions, let us know. If you want examples of a budget worksheet, I could bring that in. You know, anything that you guys are looking for, by all means, we can bring things like that in and touch on more.
We'll email you guys, we have your information, email about our November 5th date. And then I think we're going to expand on this to get into a little bit deeper with student loans, acquiring debt, buying a house, and then additional financial planning. So kind of, yeah, it's kind of, this is the foundation, this is what you
And I
need to know.
I
to
can
get the
easily
house,
do
to
that
get
next
the-
time
Yeah.
on more. So if you guys want to come back on November 5th, I can definitely bring a sample worksheet that I'll have as a handout for you guys when we touch on that, to understand savings with a budget and what that means over time, because you'll be blown away at what your potential savings would be
It's amazing.
and how simple it can actually be to get there. A lot of people are surprised, so I'll make sure I bring that in next
Do you
time.
guys know where you're gonna be? What location?
We're gonna be here.
Oh, it's
Should be
gonna be
here,
here?
yeah.
Same
That's
time,
great.
Yep.
November 5th, Saturday?
Tell family and friends.
Yep.
Just register online
Yep.
again, it's already,
Okay.
it's in the Minneapolis community app, it's
Okay.
online, so you can just register again.
We've got room for lots of people, it
Yeah,
looks like,
if
so.
it's
yeah.
helpful for your
Yep.
friends
And it's free.
and coworkers
Yep.
and everything, yeah. We'll stick around for a couple minutes if you have specific
Thank
questions
you.
on
Thank you guys
insurance,
for having us.
mortgage, whatever, so.
I know, right?